Welcome to the daily update, where I'll go over the action in the market for Friday, January 19th, and then we'll see how things look for Monday, January 22nd. Well, what do you know? We set a new all-time high with the S&P 500. We were able to break above 4,800 and then even go higher than that. And as we started to go higher with the main index, the S&P 500, we saw the rest of the market really kick into gear, and it ended up being a pretty positive day. Naturally, we always have to keep an eye on conditions becoming overbought. We also have kind of a negative seasonal day on Monday that I'll go through at the end of the video. But for right now, things are shifting back more positive, and it's always positive when you're setting new all-time highs, which now have been confirmed by the Dow, the Nasdaq 100, and the S&P 500. So let's go back and talk about what happened. At the open, we did have a gap higher open. The futures were quite positive, and we started to trail off just a little bit, but we still gapped higher and then saw some buying right after the open. We went above R1 at 47.98. We did hit resistance at 4,800. And that was, I was watching that as it was playing out. We would come right up to it and then back off, right up to it and back off. Finally, we were able to break above 4,800. Then as the day went on, we got up above R2 at 48.15. We topped out at 48.42. We never made it up to R3. That was still pretty much ahead or above where current prices were. And we closed pretty much at the high for the session. And that's usually a positive thing as well. We were up 1.23% on above average volume. Now, some of this can be attributed to options expiration, but the interesting thing is when we got above 4,800, you had a lot of option contracts that have been consistently out of the money. And here we are, options expiration day. You've got a lot of these contracts now coming in the money, and that produced a lot of scurrying because there were probably a lot of people that sold options at 4,800 or a little bit above that now they had to buy those back to clear those out because that could turn against them. You also had people that were just rolling the dice, hoping we would break above 4,800. Well, we ended up doing that. So they went from a losing position into a winning position. So it was a pretty interesting day as far as that's concerned. The technicals are positive, but we are becoming more overbought. I will show you the things. I'll show you the list and then the charts to back that up. We want to keep an eye on what's happening geopolitically, even though that just doesn't seem to be having much of an impact right now. Some comments. We did set a new all-time high for the S&P, the DJX, that's the Dow, and the NDX, that's the Nasdaq 100. So they all set new all-time highs on the same day. Small caps are still showing more improvement, not necessarily regaining back what was lost, but we've had a couple of up days now with the small caps. And mega caps and growth did outperform, especially earlier in the day. And then later on, as the market started to go up, we saw the rest of the market start to participate. Then on a short-term basis, we do have kind of a long list here of extreme positive indicators. The Stochc RSI, the Williams percent R, the CCI 14, and 20. Those are our usual suspects. And when we have any kind of a significant move, these are the ones that usually show up on the list. The stochastics, and then our standard deviations chart. We're getting a little extreme with that. We still have kind of a long list in the intermediate term. The rate of change going back 50 periods, it had fallen off the list. Now it's back on the list. Our rune indicator, the oscillators that we're following, even though they're going below their moving averages, a lot of them are still giving us extreme positive readings. The Sean trend meter, now we have both the S&P and the Nasdaq 100 bullish percent index. They're both indexes. Both of them are now back above 70. They could go higher, but we just always want to be aware of that when we get into that kind of a situation. The percent B indicator, because the Bollinger Bands ended up, they didn't move fast enough. Price moved faster than the Bollinger Bands. And then this has been on the list for a while now, the new high, new low study for the S&P based on 10 periods. Then we still have one of our indicators that's extreme negative when we look at the PMO studies. In the long term, we have the 150 and 200 period simple moving averages. They had been coming down. Now they ticked back up after Friday's session. We're still dealing with the same basic scenario that it looks like the Fed is done raising rates. And they could get to the point where they even start to cut rates. At first, the market, which tries to front run a lot of this stuff, they were thinking March. Well, that's getting a little less likely now, possibly into the spring or even the summer. But for right now, anyway, I mean, everything might fall apart next week, but we're just going with what we see right now. They're ready to party on, thinking that at some point rates are going to come down. We want to watch these economic reports because if they come in stronger than expected, the Fed has said that they would be willing to go in and raise rates if they need to do that. The dollar was down and interest rates were up. And that's another interesting thing. We've had 2 up days with the S&P. We've also been seeing interest rates going up. What's going to happen there? They usually, at least right now anyway, they tend to move in opposite directions. So at some point, if interest rates keep going up, that could really pressure stocks, or have interest rates gone up too much and they're going to pull back and give some more support to stocks. So we closed at 4.15% for the 10-year yield. We still have the 2 main yield curves that we follow, the 10 to the 2 and the 10 to the 3 month. They are still inverted, and they have been for 1.5 to 2 years. Sentiment naturally ticked up. We're still positive at 72. We're not extreme positive, at least yet. But we were coming down after giving an extreme reading. Now we're starting to go back up where we had been at 66. Our trend is now positive. The green line is above the red line on both the short and intermediate term chart. We're still below the moving averages. Okay, that's one bit of concern. We are starting to see the short-term chart start to change, but it hasn't crossed above its moving average yet. For right now, our bias is positive because we had 2 up days, and I've switched our momentum over to positive because we've shifted more into a positive stance in the bigger picture. The economic reports that came out, we had existing home sales, and I don't have a chart of this one this time. It came in at 3.78 million. That's a little bit less than the 3.8 million they had expected. Last time it came in at 3.82 million. This kind of helped spark more of a positive stance. We are seeing an improvement with consumer sentiment. How are people feeling about things? And I do have charts to show you of this. It came in with the preliminary reading at 78.8, much higher than the 68.8 they had expected and up from the 69.7 that we saw last time. So here's a chart looking at consumer sentiment. The blue line is the total, and you can't really even see that because they're crossing over other lines. The yellow line are expectations. That's looking out into the future. And how do people feel right now? That's the purple line. And they're all going up. So people are feeling better about things right now. This is our chart where I also plot the 2-year yield on here as well, where for a long time now, we've seen a really wide spread between the red line, which is the 2-year yield, and the blue line, which is consumer sentiment. And down on the bottom, this is the spread between the two, where we are seeing interest rates kind of coming down a little bit, even though they ticked up, at least in Friday's session for the 2-year. But we're seeing people feeling a little bit better as well. So for a first time in a long time, these lines are getting closer to each other, even though they're on different scales. Some blog charts from Isabel Net just to show you here. This is kind of a different look at the chart that I typically show in the intermarket analysis video, which I will be preparing over the weekend. This is when we're looking at valuations based on where the S&P is at right now. Based on that 10, 15, or 20 score, we're well above the 20 PE ratio, meaning that stocks are expensive. If you don't watch the intermarket analysis video, I usually try to point out that this is more for information. You can see here where the black line has been above the red line for years at a time. So we don't necessarily use this to make decisions, but at the same time, we want to be aware of this just to have an overall idea of how the market is valued right now. Then we look at what is the biggest driver in 2024. It should be the market, but now the Fed is coming in and they're having the most amount of impact on what the market ends up doing. There's this cliche that says, don't fight the Fed. If they're saying good things, go with that. If they're saying negative things, go with that. If they're raising or lowering interest rates, act accordingly. Now, usually what ends up really driving the market also are corporate earnings, but that's coming in second place. Liquidity, the ability to get in and get out, and that there's a lot of volume and a lot of action going on. And then AI, that's kind of the new fad these days, as well as what's going on in China, and then whatever this other is for the market. Then we're looking at quarterly net profit margins. And this, take this with a grain of salt, because anytime they say excluding financials and utilities, okay, I can understand why they do that, but it doesn't mean you're getting necessarily the whole picture of what's happening. And what we look at here is just what are the projections going out, where we're looking good for the first, second, and third quarter. We're seeing things start to drop off in the fourth quarter. So that's pretty much almost a year from now. But this is going to change a lot between now and then. But the fact that this is going up, that is justifying prices going higher. And we look at GDP, we are going to get another read in the upcoming week, where Goldman Sachs is the gray area here. And the thing to take away from this is they're positive as far as GDP is concerned. The black diamonds here, they are still positive, but they're a little bit more, they're lower in their projections going forward. The takeaway from this is both of these are at least above zero. One of the definitions of a recession is when we have 2 quarters back to back where we have negative GDP. Based on what we're seeing here, based on what we've been seeing with the economic reports, that doesn't seem to be an issue, at least right now. Then China, this is something that we're paying attention to. We're looking back at this previous chart where we have positive GDP for the US. They're actually coming down and looking at the potential of maybe negative GDP at some point, or at least GDP is falling. So this is a concern, not just because it's China, but because they have such a huge economy and a lot of US companies do business in China. So that may impact US companies. Then we're looking at the previous owned housing units, where that had really been falling off as interest rates were going up, and we're seeing this start to bounce back up a little bit. So that's showing more improvement. Then looking at the different, this is the G3, the big 3 countries, US, Germany, and Japan, and their core retail sales, where the US is looking pretty healthy that way, where Germany is flat, where we're actually seeing a decline in Japan. So the US still has, when we look at just retail sales, the US still has the strongest economy as far as that is concerned. All right, here's our intraday chart, where we did gap higher. We got up to R1 right off the bat, and right about where this R1 is, that's also 4,800. They're a little bit off from each other, but we bumped up there, came back, bumped up, came back, bumped up, and then finally broke through. And then we came right back down, and this ended up providing support. Okay, it was still pretty much a roll of the dice as to what was going to happen from that point forward, but the market took off and it went up to R2, it came up, and then we didn't see a lot of selling into this strength, and that's rather encouraging as well, where we kind of trailed off going into the close, and we closed pretty much at the high for the day. Here's the intraday chart. The initial overnight session, we were pretty much unchanged. We started to look more positive in the pre-market session. Then we came down and saw the futures starting to trail off. This is what I was watching the most. But then we just took off during the cash session, and we're not all that much changed as the market gets ready to close for the weekend. This is what's really helping out the market right now. We're seeing the blue line above the red line. That means growth is outperforming value when we look at the intraday chart. We're also looking at a real improvement here that goes back to about the 8th or so of January with S&P growth versus value. This has been showing some improvement too, and has really been giving some support to the market. Our end of day chart, where growth was up more than value for the large caps as well as the mid caps, but it was up, but not up as much for the small caps. So we're still a little apprehensive about the small cap stocks right now. We actually ticked down a little bit with this ratio, but we're at the higher end of this sideways range that we've been in when we look at small cap growth and compare it with small cap value. We're still seeing a little bit more strength here, though, with the mid caps when we compare growth to value there. So this is showing some improvement, and this could help the mid caps, which in turn might end up helping the small caps. Here's our S&P growth to value ratio, where we are continuing to show more improvement. We're breaking above both of the moving averages. We did have a recent death cross here, but if we can stay above this for any length of time, we could potentially turn this back into a golden cross. And then here's another look at growth versus value where it's starting to break out from this previous range here. It's above all of these lines in the rainbow, so it's really showing a lot of improvement. But we are still concerned about discretionary. That, even though it was up, no, it ended up being, okay, let me start at the top here. It ended up being up in Friday's session where staples were down, and we are seeing some improvement with the ratio, but it's been lagging behind as well, and that is a bit of a concern to us. Here's our trend where we crossed back above the red line, so we're now in a positive trend, but it's a weakening trend. Even though it's starting to turn back up, we're still below the moving average. We're turning up a little bit more with the short term, but we're also still below the moving average. However, we are continuing to be positive there. We are starting to see a bit of a pickup in volume as this oscillator is coming back up. Here is sentiment where we really didn't change all that much with the Ulcer Index. With the up day, we declined with the VIX. When we look at the line chart as well as the bar chart, we're coming back down into the moving averages. And the VIX of the VIX with the up day is also showing that volatility of the VIX is coming down as the market's been going up. The VIX to move ratio, which really spiked up when we were looking more negative, is now starting to come back down. The moving average is starting to turn up. So it would actually be more beneficial if this drops below the moving average and to see the moving average turn back down. The VIX to the 3-month average of the VIX is still ticking up, and it takes a while for this to readjust. But in the bigger picture, we continue to decline. The VIX to VVIX ratio is flattening out. This also takes a while to adjust. If we're going to keep going up, this will probably end up going back down. And I don't have an update here, and I waited as long as I could to get the equity put call information. It just wasn't updated yet. It's probably safe to assume, but you know what happens when you assume things, that we continue to fall. After getting an extreme positive reading, we're probably getting a lower reading with this now. That's just an assumption. We won't know until we can actually look at the charts. And so this chart hasn't been updated, and the next chart has also not been updated yet. We did see some improvement here with our risk on to risk off ratio. That is coming back up, but we need to see more follow through, and we want to see this establish more of an uptrend. Our advanced decline line studies, we're turning back up based on price. We're also turning up based on volume. As I've been trying to point out, when we were declining a lot faster based on volume. Now that this is showing some improvement is encouraging for the positive side. We're still pegged at the top with the new highs versus new lows, where we saw a real expansion in new highs. When we're breaking to all-time highs in the S&P, that's going to trigger some new all-time high, or at least new highs, 52-week highs, with the stocks that make up the S&P. And we're starting to turn back up with our 10-period moving average as well. We're looking more positive with our 19-day and 39-day advanced decline ratio. We've climbed back above zero with both, where we had dropped in the short term. This is still looking good. This is a smart money indicator. Accumulation distribution is above an advancing moving average. This suggests that the smart money is buying. We're also seeing some improvement here with the Chaikin money flow, and we're just barely starting to turn back up with the moving average. We're seeing some improvement with the cumulative NYSE advanced decline line. We're back above the moving average, and we ticked back up with our regular NYSE advanced decline line. We did see some improvement based on price as well as volume, but not quite as much with the volume. We're seeing more of an uptick lately with the price. Volume is now lagging just a little bit. And we ticked up a little bit with our other NYSE advanced decline line that we follow. So when we do our full-blown study here, we're turning back up with the NYSE common stock. We held up better with the S&P, and we're starting to go up, seeing some improvement with the mid caps, and the small caps are now finally crossing back above the moving average. So on our daily chart now, we have set a new all-time high on an intraday basis as well as a closing basis. So that's always a positive thing. I know there's a lot of perma bears out there that I was reading about a week ago that, there's all these problems, a double top. Oh my gosh, things are looking bad, negative divergences. Well, when things are really bad, you don't set new all-time highs. That's all I can say about that. On the bottom, we did see above average volume. And there's no real change here with the decision point scorecard. We are starting to get extreme in the short term with the Stochk RSI, the Williams percent R, the CCI 14, and the CCI 20. Not uncommon for this to happen. The 20 period is moving back up, as is the 50 and 200, and we're not extreme with our exponential moving average study. And I just wanted to show where the 20 period moving averages, they ended up providing good support. And this is what happens when you see a short-term pullback. We usually go back, test the 20 period moving averages once. Here we tested them twice. They held up, and now, for right now anyway, are starting to show improvement. We're going back up even more with the force index. We're above 0 in green. That's positive. And we're crossing back above the midpoint. So that's turning more positive in the short term. We're extreme positive in the short term, turning back up in the intermediate short term. And we continue to be extreme in the long short term. And we're getting up into the +3 channel for the standard deviations chart. That might mean that we've gone up a little too far too fast. And we're coming back above our double and triple exponential moving averages based on 20 periods. We were kind of bumping back into them before and dangling below. Now we're starting to shoot back above both lines. Intermediate term, we're turning back up with the balance of power where we are still above the midpoint. And this actually redrew a little bit. We went from the dark blue to the light blue. Now we're turning back more to the dark blue again with the go, no-go system. That's more positive. And we're breaking out with our highest high value and well above the midpoint. The TTM squeeze starting to turn back up just slightly here. So we're seeing a little bit of life with this indicator. And we're coming right up to the triple exponential moving average. That's the red line. This could be providing some kind of overhead resistance. We're turning back more positive with the ease of movement. We're above 0 and advancing. We're starting to get extreme again with the Arun because the green line is pegged near the top. The black line is pegged near the bottom. The black line, the red line, that's the sellers. And so the difference between the two is the oscillator. We're above 0. We're getting kind of an extreme reading there. We are no longer extreme with the S&P 500 McClellan oscillator. We've been able to cross back above this lower band. So that's turning more positive. It's negative since we're still below 0, but it is showing some improvement. So when we look at the summation index based on price and volume, we do continue to decline here. And we're kind of rolling over just a little bit based on volume. We want to keep an eye on that. The top part and the bottom part are two completely different indicators, and they're calculated in different ways. I just include them on the same chart. We're also showing some improvement with the NYSE McClellan oscillator, where we're bouncing back up, but still below 0. So we continue to decline with the summation index based on price. We're also showing a more accelerated decline based on volume for the NYSE. This is encouraging. We're turning up with the Swenlin trading oscillator based on price and volume, but we're still below 0. We continue to decline. We're just barely extreme with the PMO. We continue to decline based on price as well as volume with this oscillator. We're no longer extreme with the percent of PMOs that are rising. That's showing some improvement. We're still extreme negative with the buy signals, and we're still extreme positive with the PMOs that are above 0. We continue to be positive with the Elder's Impulse system for the S&P. We're also positive with the parabolic SAR. We're turning back up with our shorter term oscillator. This is the slope oscillator. So this is turning back more positive. The MACD is trying to turn up, but has not quite crossed its moving average yet. So looking at momentum, showing a lot of improvement with the slope, turning back up with the TSI, showing some improvement with the MACD, the PMO, and the PPO, even though there's still got a ways to go to get above their moving averages. We're still negative with our long-term oscillators, the TRIX and the KST. They are declining. And we're well above both of the 20-period moving averages in our moving average tree. We're starting to go back up. We're a little bit above 70 now with the bullish percent index for the S&P, but now it's going back up where it had been going down. We continue to decline, though, with the NYSE bullish percent index. However, we're still above 50. We're turning back up with the NASDAQ 100. These are a lot of the mega caps, and so that is showing some improvement there, but it is extreme positive. We're coming up to this red line with the Chaikin oscillator. This is just kind of the first layer of, oh my goodness, we're getting a little extreme. When we really get nervous is when we get up to the green line. The money flow index is turning back up, but we're still below 50. The ultimate oscillator is above 50 and advancing. That's positive. And we've crossed back over positive with the vortex. The green line is now crossed above the red line. We're turning back up with the RSI 14 and the RSI 9, and we're not extreme yet with either of these. Unbalanced volume is still above an advancing moving average. We're turning back up with the 200 as well as the 50-period moving average study with stocks in the S&P 500. The copy curve is turning up. It hasn't crossed positive yet. This is the percent B indicator where we closed outside of the upper Bollinger Band, so we're getting an extreme reading. The rate of change, which had worked off being overbought, is now starting to turn back up and is getting extreme again. The Sean trend meter is just getting into the first area of being extreme positive. The equal weight, it was up, but it's still underperforming the S&P. And I really don't have any line studies to show. When we set all-time highs, we've gone by everything. We just have to wait for new lines to appear. The Heiken Ashi is looking more positive. The Kagi chart is positive. The Renko has redrawn again and is looking positive, and the 3-line break is positive. Long term, we're turning back up with our 150 and 200 period moving averages, and we're still extreme positive. We're still above this weekly trend line here with the S&P going back to the 1987 crash, and we're coming above the long-term trend line with the NASDAQ 100 going back to 2009. We are still going up with our ratio between the S&P and the equal weight S&P. This just means that the mega caps continue to outperform. And we're setting a new all-time high with the Dow. We're lagging with the transports. This is a negative divergence. We're declining with the utilities. And the transports are underperforming the Dow. The Dow did set another new all-time high. It's been going sideways for the most part, but it's still, anytime you hit a new all-time high, that is positive. And we remain positive with the Elders Impulse system when looking at the diamonds. Here's another real nice up move with the NASDAQ. We're not at an all-time high with the NASDAQ yet. We are with the NASDAQ 100. And here is the NASDAQ 100. It came right up to this R level, and maybe that's providing overhead resistance. We continue to be positive with the QQQs when looking at the Elders Impulse system. We're turning back positive on a momentum basis. The PPO is now crossing back above the moving average. Here's a weekly chart just showing, yes, we did in fact set a new all-time high for the QQQs, which is the NASDAQ 100. The small caps had a good day, up over 1%, but still have a lot of damage that they need to repair. We still have this pivot point above current prices, and we're still remaining neutral with the Elders Impulse system when looking at the small caps. We're right in between this now resistance level and this support level for the Russell 2000 small caps. We're turning back up, but still below 50 with the RSI. We're positive with the trend, but we're negative with the momentum. The mid caps are back above the pivot point. They were up a little over 1%. They have actually turned back more to positive with the Elders Impulse system when looking at the mid caps. The FANG index is breaking out. That's usually a pretty good thing too. The financial sector, which had been under some weakness, is now coming back. It was up 1.6%. The dollar, it's up into the 103 range after it had been coming back up and generating a recent death cross with the short-term trend. Keeping an eye on bonds, we were actually up a little bit with the 10-year yield. Even though stocks were up, we were down based on price with the 10-year. And then looking at our growth to value studies here, we're showing a real improvement with the Qs to S&P. This is a warning sign. Discretionary is underperforming the S&P, but large cap growth is outperforming large cap value. So when we look at our different indexes here, the large caps, mid caps, and even the small caps are showing an improvement. We're still pegged at the top with the 10-day average of the S&P 500 highs minus the lows. We're still negative with our broad market range of the highs minus the lows, a 5-period moving average across the Amex, NASDAQ, and NYSE. If we still stay positive here, we could end up coming back above zero, but for right now, we are negative. Then we're kind of chopping around a little bit with our 50-period exponential moving average of the new highs minus the new lows for the S&P, but we're still well above zero. So in the bigger picture, this is positive. And we're going up with the S&P to utilities ratio. That usually happens when the S&P is going up and the utilities are going down. We're seeing some improvement here. I showed this in yesterday's video, the 19-day exponential moving average of the advanced decline ratio for the S&P. We're back above zero based on price. We're still below zero based on volume, but we are seeing some improvements here. And we're continuing to decline with the Staples to S&P 500 ratio. That tends to be positive for the S&P. So what's our outlook for Monday? We're still wondering about this whole January effect. We're still 0 for 2 with our trifecta. We'll get the final score at the end of January. Technicals are positive, showing a continuation of improvement and setting a new all-time high, but becoming more overbought. We'll get, okay, I didn't change this. We're going to get the leading economic index in Monday's session. And then keeping an eye on all the different geopolitical events. Here is the upcoming economic calendar, where we will get the LEI on Monday. We're not going to get anything on Tuesday. Wednesday is kind of not that big of a deal. But Thursday, we're going to get durable goods and another reading on GDP. Usually GDP is not a real big deal unless it comes in drastically different than the other numbers we've already been seeing. The big inflation report, the other inflation report after CPI, we're going to get PCE prices in Friday's session. Seasonality. We're looking more negative with the Dow. We're only up 33 1/3% of the time, where we're neutral to negative with the S&P and NASDAQ. We're now going to be in the week after options expiration, where we tend to be up more than we are down historically. Here's the newer chart from Carson showing the green line is what's been happening so far in 2024 compared to what the composite says should be happening. And we tend to see some choppiness and a lot of sideways action before we tend to turn more positive later in the year. We will be on the 14th trading day of the month, where we're pretty much flat during an election year to slightly positive based on the Stock Traders Almanac. And wondering, where are we, if anywhere, in here with the January effect? Also going sideways when we go from 1950 up to the present time, looking at an election year. Please keep in mind that after about the 45-day period or so, we often see some weakness before we see some strength going forward seasonally. And we also see that in this chart, where we're pretty much flat with the Stock Traders Almanac during an election year, where we see some weakness and then some strength after that. I don't know, maybe we're getting back to being more historically what happens when the current president is running for re-election. Monday's session is the most positive of the week. We do have negative seasonality historically, but in 2023, we've been up 67.3% of the time in Monday's sessions. The scenarios can't really go with the down one right now, and I should have highlighted this. We would go with the up scenario right now. We're looking more positive, even though be aware that we are showing some overbought indications. We're not going with the sideways trend right now, even though the ADX charts are below their moving averages. They're both still above 20, and they could be starting to shift and turn back over to positive. The warning signs. The risk-on posture, it improved in Friday's session, and it's showing some improvement over the last couple of days, but we want to see more of an uptrend there. The transports continue to negatively diverge from the Dow. The 1 to 3 month bond spread, it's still positive, and it should be negative, and I have not been able to find a reason why. The Copic curve is negative, but showing some improvement. Our oscillators, they are below their moving averages. Some of them are still extreme. In the short term, we are starting to see them turn back up. We need to see more follow through for the momentum to turn positive. Positive signs. Growth continues to show improvement. The daily special K chart is positive. I don't know about the 5 period. I can guess that it's probably still going down. I can guess that the 253 period is still going down. The parabolic SAR chart is positive. The vortex is now crossed back over positive. The S&P and the NASDAQ 100 bullish percent indexes are positive, but getting extreme. They're both above 70. The Zohorchak method, we did have a new signal there drawn. We now have a full-on buy signal. So that's positive. And we're turning back positive with the momentum for the NASDAQ 100. The Russell, the small caps, and the mid caps are still working off of longer-term uptrends. Small and mid cap growth is positive, more or less chopping sideways. We're seeing a little bit more strength with the mid caps. The financial sector, after having a rough few days there, is turning back more positive. And our longer-term new high, new low study is still positive, even though it's been coming down a little bit in the short term. So our conclusion, we're positive and still showing some more improvements. We did end up regaining the 20-period simple moving average, but be aware that we are also overbought. And I thought I updated this. I could have sworn I changed this slide. We're still looking a little bit more positive when we have a longer list in the intermediate term. and we still have a couple of oversold indications, believe it or not, and we're still positive in the long term. So when it comes to the short term, we're positive, improving, but showing some overbought indications. Thank you. I hope you found this helpful. I will be preparing the weekly video, the intermarket analysis video, and the deep dive video over the weekend. If you're following football, I hope your team wins. Have a great weekend, and I will talk to you in the next video.